Bloomberg Audio Studios.
Podcasts, radio, news.
I'm Stephen Carroll, and this is Here's Why, where we take one news story and explain it in just a few minutes with our experts here at Bloomberg.
Mr. President, with the current value of the dollar, do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great.
Donald Trump might not be worried about the dollar's weakness, but investors are certainly taking notice.
You know, in some ways, the political tail is wagging the kind of the economic dog, at least, temporarily.
It's very unusual to have people revising the U.S. economy forecasts higher and higher, and the market selling the dollar like this.
Yes, it is true a weaker dollar boosts exports. However, we have, in the United States, has $39 trillion of debt on its way to $40 trillion plus.
The U.S. government does need to be very careful because there is already a sense that the dollar is no longer the reserve currency.
For several years now, market participants have been looking for an alternate reserve currency to the U.S. dollar. You're seeing that in gold now.
In the 12 months after Donald Trump returned to the White House, Bloomberg's dollar index dropped by more than 7%. The US currency is under pressure from worries including rising deficits, the independence of the Federal Reserve, and trade frictions. 2026 has brought new challenges that have pushed the dollar to its lowest level in 4 years. Here's why a weaker dollar is ringing alarm bells. Our Markets Live executive editor Mark Cudmore joins us now for more. Mark, first of all, can you put these moves in context for us? How significant has the weakening of the dollar been over the past year?
If you take it from the February 2025 peak, it did spike into earlier 2025. The Bloomberg dollar index is down about 11% since then, which sounds extremely dramatic, and it is dramatic. But I should say that, moves that magnitude haven't been too unusual over the past decade. In fact, this is the fourth move of such a scale over the past 10 years. Now, we're getting towards the extreme move we've seen in that era, that the largest peak to trough drawdown of the past 15 years is only 14.3%. And at the pace we've moved in the last few days, if that continued at such pace, which might be extreme, we could get there very, very quickly. Some extra context is that the dollar was very elevated into the end of 2024, even more so into early 2025. As I said, it kind of rose into a peak in February. So despite the big drawdown, we're not far below the 10-year average despite the drop. And that's been a rising 10-year average as well.
So let's get into what's been driving this then. How much of it is about policies that have come from the Trump White House?
A lot of it, really. So the dollar is expensive. It probably should be expensive given the structural advantages it's had for some time, in many ways for decades, in terms of deep capital markets, rule of law, strong growth, great demographics, lots of commodities, etc. It's got many reasons to be positive. But on a purchasing power parity basis, only really Swiss franc and Israeli shekel are much more expensive. In fact, as of this week, Aussie dollar is kind of maybe passed it out, depending on exactly which day you looked, but it's pretty similar. So it's one of the most expensive currencies in the world on a purchasing power parity basis, and it probably should be. But it does, as a result, it's got a building structural negatives. Now, they've been there for a while. The US has got twin deficits, a large budget deficit that's been adding to its massive debt burden, and it's also got a current account deficit. So those kind of negatives have been there for some time. What has changed is Trump's policies. I think particularly around trade, but you can't ignore the administration's pressure on the Federal Reserve, which is encouraging easier monetary policy than orthodox economics would suggest. But around trade in particular, it's the fact that, unlike in his first term, he attempted to start a trade war with pretty much everyone at once. And it's that multilateral fighting, if you want to call it, multi-front fighting, maybe is a better way to put it, that has been so damaging for the dollar. And then it's kind of been the whiplash since then. So ultimately, you're losing policy certainty in trading with the US. So the post-World War II era has meant that every part of the world, if you're a business owner, you prefer to be in a supply chain with the US, both with US companies and the US consumer. Not only was it the biggest market, but you could rely on that market and you could rely on rule of law. And therefore, if you're a supplier, you'd offer cheaper prices to supply to the US than to some other countries in the world because it was better to get supply chain. And therefore, the US had a discount for trading against the world. And that's being eroded. Suddenly, the US is going from being the most preferred trading partner to arguably less preferred. Now, maybe that's going too far for the moment, but certainly it's got no special status. So that's making it more expensive to trade at the US, and that's decreasing the interest in the dollar. I think the extra context here is that the world was overexposed to the dollar for good reason, even despite those negatives. So Trump's policies have been the catalyst, and they've been a very real catalyst, but they've not necessarily completely destroyed some of the underlying fundamental negatives. They've just made people care about those twin deficits because of that new policy uncertainty and because of that pressure on the Fed.
So how far could this trend of weakness in the dollar go then? Could this be something that's a permanent shift away given that policy backdrop?
So personally, I'm expecting another 5% down the Bloomberg dollar index this year. I tend to be a dollar bear, and I kind of expect we'll get down to the level. That'll bring us down to the lows of 2018, 2020, 2021. There's a not insignificant minority risk of a much more dramatic decline over the coming years. Say if you go back to the lows of 2008, 2011, that would mean another 20% plus decline from here in the Bloomberg dollar index. And if that's the case, the world would be in trouble because the reasons to buy the alternatives like the euro and the yen and the yuan and other fiat currencies are much less compelling than before. So when we were doing that going into the GFC, global financial crisis, we believed that, hey, the euro is suddenly a viable reserve currency and maybe the yuan is too. But we've undermined all that, and certainly Japan has undermined that. So if the dollar really does fall that much, it means an extraordinarily high inflation period for not just for the US, but probably for the world, and probably a lot more volatility. Now, are we set for a permanent shift away from the dollar? The answer is yes, but not in the way people think. We have been in a permanent shift away from the dollar for a number of years now. De-dollarization is a real underlying trend. But it's not how it gets sometimes brought by some kind of panic mongers to extremity. What it's saying is that people want to reduce their reliance on the dollar, but it's still going to remain the most dominant currency in the world. It's still the world's reserve currency. So it's just that dependence on it will decline a little bit at the margin. And that has been an established trend. It's a trend that's set to get more impetus to go even further. So I expect that dollar's share of global FX reserves, for example, I think was 57% as of the last quarter. Correct me if it's by a percent or two, but around there. I expect in the next few years under Donald Trump's term it could be below 50%, but it will still, even if it goes below 50%, still be far bigger than the share of any other fiat currency out there. So yes, there is a permanent shift away in the dollar. That permanent shift away in the dollar is expected to intensify. This is not about abandoning the dollar. There is no viable alternative just yet. And if we get to a world where we truly abandon the dollar, watch out. That's the kind of real panic mongers, zombie apocalypse type world.
So should we be disconnecting then dollar weakness from the question of the dollar as a reserve currency?
Great question. And I would say yes. It's not that it may disconnect entirely, but I don't think they should be so closely entwined. Dollar weakness is very likely to continue. The dollar has been the world's reserve currency for decades, and it has had depreciation trends and appreciation trends. As I said, we're still, like roughly 25% above where we were in 2008, and that was after a multi-year depreciation trend. That didn't see the dollar replaced as the world's reserve currency. It just saw its share of reserves decline. So the world is going to continue moving away from the dollar. The dollar's share of world reserves is going to continue happening, and probably at an accelerated pace. But it will remain the primary reserve currency of the world for a long, long time to come, unless we're in complete panic stations about all financial markets.
What could reverse this? What could drive investors back to the dollar as a safe haven?
So what's really interesting about all this is that the corollary of what I'm saying there is that in extreme risk aversion, despite this trend away from the dollar, it'll still work as a haven in risk aversion. It just won't be the first port of call. And again, you can look back to the GFC or the pandemic as kind of good examples of this. But, the GFC happened, part of the reason the dollar was in a depreciation trend, it was a kind of a US-led financial crisis. But ultimately, because it's the world's reserve currency, when you get extreme risk aversion, what that means is deleveraging. And when you deleverage out of financial assets, you're going back to cash. And if the world still has the largest share of being reserves, it's still the main reserve currency, that means ultimately going back to the dollar. It's a little bit of a simplified way of looking at it. But it's saying that in extreme risk aversion, the dollar will still be a haven. And I expect that the coming years, is despite the fact that I am bearish the dollar and I think that the dollar can depreciate a chunk more, I think we'll have bouts of the dollar really rallying on the way down due to that kind of risk aversion. What will drive investors back to the dollar on a more structural, sustainable basis? I guess restoring the US edge as the preserve of stable and reliable policies and economic policies and international policies. And that looks extremely unlikely for the next 3 years. And, maybe long term, maybe the damage has now been done for much longer term. But, the US is no longer the ideal partner of choice that it once was. It doesn't mean that it's particularly poor. It had a special status before. It's just lost its special status. It's now just like everyone else. It's, deals come and go. So I don't think it restores its special status as preferred currency for many years, which is partially why I believe in a multi-year dollar downtrend, even if not some kind of doom-mongering prognostication.
Okay, Mark Cudmore, our Markets Live executive editor, thank you. For more explanations like this from our team of 3,000 journalists and analysts around the world, go to bloomberg.com/explainers. I'm Stephen Carroll. This is Here's Why. I'll be back next week with more. Thanks for listening.